agents and all those out there in social media land. This is Dawn Connors, and today we're talking about why are interest rates rising so quickly and what can we do about it. Before we get started, please like, share, and subscribe to my YouTube channel. I put out multiple videos 3 days a week so that you're in the know when it comes to mortgage financing. All right, let's get started. So the Federal Reserve met last week and they said they need to unwind their balance sheet. They need to unwind their balance sheet. What does that mean? Well, the Federal Reserve has a lot of bonds that they have purchased over the course of these years to keep interest rates low and suppressed, especially during the pandemic. They have chosen to buy a lot of mortgage-backed securities that keep interest rates really low to avoid a recession. Well, they need to unwind their balance sheet, meaning they need to sell off some of those bonds, quite a few of them, because they have too many holdings of U.S. government bonds. Well, in order to do that, they will start selling off their bonds and to investors, and as they sell them off, the interest rates will go up. And so that's what you're seeing. You're seeing interest rates rise, and they're going to continue to do that and aggressively, they said last week, so that they can get their balance sheet in check. Well, in doing so, it causes the interest rates to go up. So what can we do about it? Well, there's a few different options that you can consider. Number one, I have to tell you that you're going to still see supply issues because there's supply chain issues. There is 4 million, we're off housing starts by about 4 million homes for existing demand. So that means that there's going to continue to be a demand for housing, and housing prices are going to continue to go up, we believe, over the next 3 to 5 years. While that's happening, though, these interest rates are also climbing. So as they do, you will see people that start to get priced out of the market. In other words, as rates rise, house prices rise, you can no longer buy a house. So if you're in that marketplace and you're looking to buy, a key for you is to look to buy this year and to do it before interest rates continue to climb where you can't afford to buy the house anymore. The second thing you can consider is what's called an adjustable rate mortgage. There are mortgage rates that are fixed for 5 years, 7 years, 10 years, and then after that they become adjustable rate mortgages. In doing so, what that does is it allows you to take a lower interest rate initially for the first 5, 7, or 10 years, whatever your choice is. The lower the time that the rate is locked for. If it's 5 years, you'll get a lower interest rate than 7 or 10. Well, as these interest rates rise, the spread between the adjustable rate and the fixed rate will be greater. Currently, the spread is about 0.5%. So if rates are at 5%, an adjustable rate is usually at 4.5%. So as this continues to happen, you can get more house with a lower interest rate. The other thing you should know is because it's fixed for 5, 7, or 10 years, it's thought that we will have a recessionary period in 5 years or less. And if we do, then usually the federal government swoops back in, buys more mortgage-backed securities, and the interest rates go down, allowing you to refinance your adjustable rate mortgage back into a fixed interest rate. So those are the thoughts. I think the key is what you can do about it is look at an adjustable rate mortgage if the payment is becoming too high for your qualifications and for your comfort level. Number two, look to buy a house and buy a house now before it reaches a place that you can't buy. And number three, talk to a really trusted loan officer that will lay out your options for you and take the time with you to meet with you and to lay out what you can do, adjustable rate versus fixed rate, and see what is best for you and your family. This is Dawn Connors at Mortgage One, providing you fantastic mortgage solutions, and thanks for watching today. Have a wonderful day.